if you want to make changes to increase your retirement contribution, you need to do that like now.
Yeah.
Because you may only get a couple of paychecks where that takes effect. So what we do for a lot of our clients is, mid-year, end of Q3, we're gathering paychecks and we're starting to project out income. So that, and there's a couple of reasons for this. Of course, as you mentioned, we want to recognize where they are in the tax brackets. Is there any benefit to either deferring or accelerating income, whether it be capital gain or ordinary income? But we're also trying to check on, hey, how are your 401k contributions, your 403b contributions tracking? How are your HSA contributions tracking? What about the dependent care FSA? All of these different elements, just making sure that everything's funded properly. And then if we see something that doesn't line up, then at least we can raise that question to the client and make adjustments to it. Well, it's been a long time since we got together. It feels like longer than it should be. Lots changed. So welcome to the Money Alchemist podcast. I'm your host, Brent Gargano.
And I'm Ben Jones.
And we are here to talk a little bit of everything. We've got, like I said, a lot has changed in the last couple of months. We've got an election behind us. We've got holidays coming up. We've got geopolitics changing. So
I think the best change is that we're both healthy. So yeah, what happened was you got COVID. No, I got sick. And then you got COVID. And then I think you went on some sort of fishing trip or something. But it was like three weeks in a row that we couldn't get together. And here we are. Oh, and I took some time off too. So, but it's good to be back and plugged in. And yeah, you're not kidding, man. There's been a lot of changes. So we had a little thing called an election. Comment on that real quick. How did that play out and compared to your expectations? Well,
I think one of the interesting takeaways as a market guy was like the news. If you looked at some of the betting markets, they pretty much figured it out like hours ahead of the news outlets. So, I think there's this interesting shift in culture as far as like, where are we getting our information? And no longer is the news like the source, right? The sources are actually like closer to the event. And in this case, it was, I think, Polymarket was one of the...
Yeah, I heard that the founder of Polymarket was raided by the FBI. I didn't read much into this. But did you hear about this news?
No.
I didn't know much about it.
Well, the idea is they've kind of taken situations, like will Donald Trump win the presidency? Is the Senate going to be Republican or Democrat, right? Those kinds of things. And they allow people to essentially like place bets on these things. And they use the positioning on these bets to figure out statistically where the collective conscious thinks the outcome is. And again, back to the election, the election effectively was settled on Polymarket 3 or 4 hours before the news outlets actually announced it.
Yeah. So, the Polymarket bettors supposedly used better, more accurate information. So one of the flaws they say with these public polls is that you're asking people directly. Well, for one, the people that respond to the polls are already like they're biased towards those kinds of folks that, are comfortable announcing who they're going to vote for, which that's typically a very guarded, people are very guarded when they get asked that question. Like most normal people are. So people that are comfortable just telling a stranger I'm voting for this person kind of biases the results to people that are a little bit less grounded. I don't know if it might be generalizing too much, but I think that most people that are reasonable, they're not quick to tell a stranger on the phone who they're voting for. So those polls are biased, and here's how I read some of the Polymarket bettors got around that. They had some of the more wealthy individuals that bet on this election, they paid for surveys done that wasn't asking who are they voting for, as who your neighbors vote for. because your neighbors put up yard signs. People have no problem saying who their neighbor's going to vote for.
Sure.
But they are guarded when they say who they're going to vote for. So their response rate was vastly improved just by a modification of that question there. So that I read this.
Isn't that true in a lot of these studies, is like how you ask the question matters so much to what the outcome is that you get.
Especially when it comes to very sensitive questions like that. So I think people are slow to respond, and they should be, to certain questions like how much do you make? How old are you? What's your political affiliation? What's your religious affiliation? Like, these are touchy topics that people aren't just going to just open up to a stranger. You got to have a close relationship. So any surveys that kind of focus in any of those areas, I find to be suspect, unless the questions are designed in a way to kind of remove that personal, like, protective barrier.
Sure.
So anyway, that's how the poly markets ended up being a little bit more accurate, is because people had real skin in the game. So they tended to really weed out the bias in some of these surveys like that. And I think that's how they ended up being more accurate. And by the way, the campaign surveys, which are internal, it's known that they are more accurate because they do this kind of thing too. So I'm not sure why the political, what are these things called? The surveys? No, they're called polls. I'm not sure why the polls that are hosted by these major news organizations don't factor this stuff in. Maybe they do, and they just...
Should they just essentially overlay an adjustment once they have their results? They should just adjust them.
No, here's the conspiracy theory, if you will. Conspiracy theory is that the company, we got to think, it's all about incentives. Follow the money. So what was the last election you can recall where the polls weren't deadlocked? They weren't super close. I don't know. That they're always, razor thin, super close. And if you think about it, well, how much money is spent on political campaigning? I mean, it's billions of dollars. So, if you're ABC News or you're Fox News or whoever, and you're wanting to maximize your revenue potential for political ads, aren't you going to position the race to be as tight as possible?
Race.
Yeah, it's a hot race. You better give us another $100 million to advertise your candidacy, because otherwise you're going to lose. So and I actually believe that. I think that's probably pretty close to the truth. And that's why a lot of folks will say, well, Fox News biases their polls to the Republicans, and CNN to the Democrats and all this stuff. I don't necessarily think that's true. I think that they're both incentivized to maximize revenue and ads. So they're both going to. By the way, I also think too, like, let's say your preferred candidate is down in the polls. Does that demotivate you to go vote? I don't necessarily think so. I think in some ways it have the reverse effect. So who's to say that, artificially depressing your preferred choice versus, showing them as way ahead, what effect is that going to have? I'd like to see a study on that. But back to my point, I think that it's just that simple. It's, they want to show a very tight race because that incentivizes, political ad spending.
Sure.
Yeah. Well, anyway, here we are.
The election is over. Mm-hmm. We now have a president-elect. Mm-hmm. One way or the other, we kind of have to sort out, what does this mean? And for the wealth management community, there's definitely some big implications, because something we've talked about on this podcast before, the Trump tax cuts from 2017 or that were put in place in 2017, those expire at the end of next year, and how those legislate out is going to be a big deal. We have a lot of budget conversations coming up next year. I believe we have a debt ceiling. We have a 2025 budget reconciliation, I believe, and then also 2026 budget questions. So next year is going to be a contentious year for, taxes and fiscal policy. Of course, the markets, kind of initially we saw a big bump after Trump won Trump won, and we saw some of the banks, some of the industrial companies kind of surge. We saw a big rally in the U.S. dollar, which put some pressure on international stocks. And then really we've started to see some of that mute out. But this season, I mean, November and December are seasonally two of the strongest months historically for the stock market.
Mm-hmm. Well, it's like how high can stocks go? I was reading an article over the weekend talking about valuations being at peak. I mean, the weighted S&P 500 price to earnings ratio is at an all-time high right now. It's floating somewhere above like 30, 31. And even in the dot-com bubble, that wasn't the reality. And, one wonders like, okay, well, what's driving this and how much higher can it go?
Here's the deal, right?
Mm-hmm.
I mean, I think one of the interesting things is you notice during the period of inflation that we saw
mm-hmm.
in late 2021 and 2022, gold didn't really appreciate a whole lot. Now, we started to see as we got into 2023, 2024, Bitcoin actually started to outperform. This year, we've seen gold outperform for a majority of, the kind of had Bitcoin outperform gold and then gold outperform. But the point is Bitcoin and gold in the investing space, they're somewhat related, right? Like Bitcoin is almost digital gold in a sense. So do you think Bitcoin's taking some of the pricing of the flows from gold?
Yeah, definitely. I think you got those, the gold bugs, the stable money bugs. If it weren't for Bitcoin, a lot of the market capitalization that's flowed into Bitcoin would have probably found its way to gold. But Bitcoin's here and is here to stay for I think foreseeable future. So that's kind of pointless to even pontificate. But what's interesting about Bitcoin is that because the market cap is so much smaller, gold is quite a bit larger. I've seen some estimates where the total market cap for gold is somewhere north of $12 trillion, probably more than that. That was like a data point that I read last year before this massive rally.
I just looked it up, 17.7 trillion.
Yeah, that makes sense. So it's quite a bit larger. Bitcoin's market cap is 1.7 trillion, and gold is already like a volatile commodity / precious metal. So Bitcoin is just very volatile. It's speculative. It's pure, it's not pure speculation, but it's definitely speculative. And the reason for the rally, I think, is because, the Donald Trump ran a campaign. I mean, he spoke at the Bitcoin convention this past year, and he basically claimed that, hey, I'm going to start a Bitcoin Federal Reserve Fund. We're going to have the government basically buying X amount.
Effectively what they did with gold, right?
Yeah, with Fort Knox. Yeah, so they're going to create supposedly a Bitcoin strategic reserve. Now, of course, this has to be approved by Congress. So right now it's just speculation, but that's what's driving a lot of this Bitcoin activity. It's just speculation that one of the largest buyers in the world, the U.S. federal government, is going to come in and be an active buyer, which would be a pretty big deal if it does end up panning out. But as I said, it's got to pass Congress. That's a lot of scrutiny it has to go through. So it wouldn't surprise me to see some heightened volatility in that asset this coming year. So anyway, take that for what you will. But this is just one little thing for what's coming in 2026. I think market valuations are very, very rich. I think the Fed is going to pivot on its pivot. We're already starting to see that with some of Jerome Powell's commentary. They're basically talking about slowing down the rate of increases. The market's forecasting another rate cut this month and another quarter point rate cut next month. But after that, it's anybody's guess because we're starting to see core inflation come back.
Well, and surprisingly, if you go and look at short-term interest rates versus long-term interest rates, ever since the Fed has started cutting in September, long-term interest rates have actually gone up.
And now 30-year mortgages are back to where they were
before the Fed was cutting.
Yeah, before the Fed was cutting. So they're north of 7% now. So, it's kind of the Fed cutting really isn't having its intended effect of reducing the interest burden of debt holders. In fact, it's having the opposite effect. And it's actually hurting the U.S. government too, because the net interest expense line item on the budget is now inflating, and it's become an issue.
Well, and there was also this belief that some held during, over the last couple of years, that when you earn 5% on your cash, it turns out wealthy people have a lot of money to spend.
Oh, yeah.
Right. And so what's happening now is the cost of borrowing, like borrowing on a house, not going down, but the amount of money that your money market fund is pumping out, it's dropping.
Yeah.
And so, what does that do because let's face it, lenders, a lot of the people that are buying stocks are have a lot of assets, right? And so if their assets can pay them a higher guaranteed rate of return through something like a money market, then they may have more comfortability spending money and keeping the economy up.
Yeah. So it's an interesting thing. Like I've heard this talked about and several other, articles and forums that I'm part of. And the idea is, does the Federal Reserve rate increasing, does that actually add to inflationary pressures? And I would argue it probably does. Because if you think about inflation broader, we let the government force us into a channeled view of inflation, meaning inflation only impacts goods and services. Well, we know that's not true. One of the most important things that we accumulate over the years isn't goods and services, it's financial assets. It's your house. It's your 401k, stocks and your portfolio of bonds and stocks and all this stuff, precious metals, whatever you have. Like, these things matter too. How much of that you can purchase does matter. So if you factor in inflation as a component of the price increases of goods and services, but also the price increases of financial assets, it becomes pretty clear where the government excess spending goes. They say that the quantity of dollars in circulation increases by approximately 7% per year. When if you think, well, inflation like CPI, they say it's 3%. It's like, where's the rest of that go? Where's 4% go? Well, it probably goes into financial assets. So, I think that so long as the Federal Reserve keeps rates higher on the higher end, that obviously hurts people that are dependent on debt, short-term debt like credit. So the Federal Reserve federal funds rate impacts mostly like floating rate debt.
Right.
And floating rate debt those are the kinds
credit cards, home equity loans.
Typically, these are debt instruments that not high net worth people use. So these are folks that typically have less means than someone who's multimillionaire or billionaire. So it tends to reduce the CPI style inflation, but accelerates asset price inflation. Whereas, when the Fed cuts rates, it has like the opposite effect. So I think that overall, the impact on total inflation is somewhat neutral. But when the Fed cuts rates, I think it helps those who have, revolving debts and don't have a lot of savings in the bank. But it also, drains from, asset price inflation. But anyway, I don't think it's a meaningful lever.
The reality is a lot of the spending, the consumer spending that drives our economy comes from the upper end of the consumer spectrum. And those people have been, flush with income coming from their money market accounts where they're sitting, in a way that they haven't been over the past 10 years. I mean, I know you and I both have clients that are sitting on, a large chunk of, let's call it cash, but it's, savings, deposits, money markets, some kind of, maybe cash equivalent. And for 2 years now, they've been getting used to, pumping 5% out. I mean, that's a ridiculous number. If you really think about, we've talked about as retirement planners, you think about this 4% rule, $1 million portfolio should be able to reliably produce 4%, $40,000 a year adjusted for inflation over time. The last 2 years has given that portfolio, assuming you put it all in cash, $50,000 a year, and that is changing. And I think that, there's a lot of things that could be negative effects on the market. If you think about that impact on consumers, you think about the ability for taxes to increase, but then also a big one that we haven't talked about is a big part of the GDP growth that we've seen is government spending.
Yes. And approximately 23%, I think.
So, and government spending, what do you think is going to, what do they hope to do to government spending? At least, I don't know, Elon is in charge of this now, isn't he?
That's kind of an interesting variable going into 2026 is the DOGE, Department of Government Efficiency, which is something of a misnomer because it's technically not a government department. It's from what I have learned is an outside consulting agency, if you will, consistent of, of course you got Elon Musk and Vivek Ramaswamy kind of guiding it, but then you've probably got an army of analysts underneath, and they're going to essentially give recommendations to, the executive and the legislative branch. Now, many of the cuts from what I've learned that are likely to be proposed can actually be done at the executive level, which is interesting because that means it's not going to take congressional approval to cut these departments.
So Donald Trump could just sign an executive order and say, see ya.
Yeah. And a lot of that is because of recent Supreme Court decisions like the Chevron deference decision, where the argument is these departments are not constitutional and therefore they've exceeded their congressional authority, and the executive branch can cut them down to size because Congress never authorized them to get to that size in the first place. And if there's a lawsuit, which these things are inevitable, the Supreme Court probably won't put it on the docket because there's no legal justification for the lawsuit. So that's the way it's been couched in some of the articles I've read, which we'll find out. We'll find out in 2026 because I do think that this is more than just a campaign promise. There seems to be a lot of authenticity behind the initiative. I think some of it will be actually a good thing. I don't necessarily think that it's healthy for our economy to be dependent on government spending. I think making the government more efficient is a net positive. I have a tendency to think that deficit spending migrates inflation, it diverts inflation into financial assets.
Just like we talked about.
Yeah. And the reason why is pretty simple. If you think about it, who are the primary benefactors of government spending? They say, a lot of it are transfer payments, but let's figure this out. Let's follow the money. All right. The biggest line item in the government spending is Social Security, I believe. And if you think about Social Security are direct payments. How much of the average Social Security check do you think people put in the bank and they save?
Not a lot.
Not a lot. They spend it. And it ultimately finds its way into the pockets of Netflix, Amazon, healthcare providers, you name it. Let's say half of it is banked. All right. Okay. Then it goes to build the net worth of retirees. The other large component of government spending is Medicare.
Well, national defense. So I'm looking at it now. So 21% of the budget, Social Security, 18% national defense.
Okay.
15% health.
Well, national defense is an easy one because who owns Northrop Grumman? Who owns, General Electric and
L3. Yeah.
These are probably, granted,
massive government contracts.
The majority owners of these companies that benefit from defense spending are folks who own, they're asset owners.
And this is on topic, but adjacent. I read an interesting article that postulate, in this Ukraine war, there's all these tanks that are getting used by I forget if it's Russians or Ukrainians, but the point is these tanks are getting taken out by drones. You have $1 million tanks that are being destroyed by $2,000 drones, right? That's an interesting thing when it comes to, we think about, you talk about inflation and the fact that inflation is driven by all this money coming into the system. Well, I guess my argument against why inflation hasn't been higher is that you have technology which is deflationary.
Absolutely.
And this is a great example of it, where you can have a drone that you built for $2,000 and it can take out $1 million tank. And then you ask, what does that mean for defense spending?
I would say that's a tragic example, because the trade-off in life there is it's asymmetric. It breaks my heart to hear that, but that's the reality. It's brutal. I think, though, that government, the point I'm trying to drive home is that government spending, when you follow the money, it's easy to see how most of this spending finds its ways it terminates in the pockets of higher net worth individuals, ultimately, like disproportionately so.
Sure.
So anytime you see government spending, it accelerates the wealth gap. And I think people don't see it that way. They see it the opposite way, which is tragic. They think, oh, well, the more we tax and the more we redistribute assets, the more equal things will become. It's very counterintuitive, but I think it's the opposite. I think the more we see government spending, the more that those assets are diverted into financial, the more the inflation is diverted into financial assets. Because if you think of it in terms of the government, is it more efficient for a government to work with 1,000 small company defense contractors? Is it more efficient to work with like one big one?
Sure.
They're going to work with the one big one. Now, the opposite is true. So let's say the majority of growth is from small business. All right. Well, that's different, because then now you can assume that a lot of this growth in the private sector, in order to sustain that growth, you need to have worker productivity. In order to have worker productivity, you need to have wage inflation and wage growth, or at least competitive wages. So, and then that money is more democratically spread out, and people, everyday people can allocate a portion of that into savings and wealth. It's not just a transfer payment. It's like, you are being productive, you're adding value to the economy. So you're increasing the size of the pie, and by exchange, you're increasing your capability to store some of that pie. So it's a far more effective way to democratize wealth, I think, is to enable the private sector. So I think personally that this Department of Government Efficiency, if it is effective, it'll be short-term pain, long-term gain. The one thing I want to keep an eye on, though, is will it disrupt those who are already dependent on these transfer payments? Because you and I will both agree, I think, that there's very few financial plans that we do that aren't dependent on Medicare and Social Security.
Sure.
The majority are. So you can't really touch that.
I know. There's so many people that think that the government's just going to like get rid of Social Security, or the reality is Social Security is so important for so many people in this country. I just don't know how you would completely eliminate it.
I don't think you can. And if you tried to eliminate it or cut it in any way, there would be an economic...
It'd be like the least popular thing that's ever happened.
It would be political suicide, and it would be economic catastrophe. So I think there's a limit to what the Department of Government Efficiency could accomplish. I really think that though it's probably not going to touch these Medicare and Social Security systems.
Well, because if you add it up between Social Security, healthcare, and interest, we're spending quick math here, 60%. No, sorry, 50%. Yeah, 50%.
50% of the budget.
So 50% of the budget goes to just Social Security, healthcare, and then interest. And that's half of the money.
Yeah.
So, even if you cut everything else by 50%, you're still only reducing spending by 25%. Does that even matter?
Yeah.
And so anyway, I want to get onto some things that some of the listeners can take away. We are heading into year end. There are a lot of, the environment is shifting right now. Interest rates, short-term interest rates are dropping. Long-term interest rates are rising. Politics are changing. We've got new policies to be implemented next year. We have actually, so there was retirement, policy called the Secure Act 2.0 that was legislated on roughly a year ago, and that kicks in. Some of those things kick in next year. So what what kinds of things are you working with? I mean, I guess I can give some commentary, but what are you doing with some of your clients as we get close to this year end and get into next year to be thoughtful about this?
Well, there are things that you do every year that are the same every year, regardless of all the change. We've had a lot of change this year, but there's still some things that are just standard procedure that you should go through. The obvious is, harvesting losses. So you should be reviewing your portfolio. Obviously not IRA accounts because there's no tax loss harvesting within qualified accounts. So this doesn't apply to Roth IRAs or 401ks, but these are investments you hold outside.
But in your non-retirement accounts where you can have capital gains or losses.
Yeah. You should be looking at losses where they exist and harvesting those losses, meaning you have to sell the security. You can't rebuy it because you have to be cognizant of the wash sale rule. So you can't sell sell your security and then go and buy it right back. You have to wait another 60 days or exchange it.
The example, and this isn't a recommendation by any means, but like if you sell Ford at a loss, you can't buy Ford back, but you can buy GM.
Yeah. So it has to be a different security, but you can't sell a Vanguard S&P 500 fund and then buy a BlackRock S&P 500 fund. They have to be
the rules
different.
Around that are kind of squishy, right?
Yeah.
I believe the way that it's written is the securities cannot be substantially identical.
Correct. Yeah.
And a BlackRock versus a Vanguard S&P 500 fund. Now here's the thing: your 1099 is not making the determination on what's substantially identical.
Correct.
Right. So you can go in and sell your Vanguard S&P 500 fund, recognize the loss, and buy the iShares version. And, your brokerage company is not going to pick that up as a wash sale.
But it would not stand the test of an audit. I can tell you that.
But if you were doing, it will pick up on wash sales. So, your 1099 generated by your brokerage company will know if you sell a stock at a loss and then buy that same stock back, and it will actually adjust it for you. But if you buy a different fund, it doesn't do that. Now, whether your CPA is going to catch, the Vanguard iShares flip and the fact that tax loss, even though maybe it's recorded on the 1099, should it be or whatever, we get into semantics. But I bet you there is a heck of a lot of tax loss harvesting that's done that way, though.
No doubt.
I would be willing to bet that a lot of people, how many people are sitting on losses in the S&P 500 right now, though?
Oh, in the S&P 500, probably not a whole lot, right? But here we're talking about mainly like
But same thing could go for an international fund, a small cap fund, right? And, if you sell an ETF that owns an index and you buy a different ETF that owns that same index and try to tax loss harvest, I'm not a CPA, but
I think most tax loss harvesting exists at the individual security level. I don't think people are really doing a lot with index funds or even just diversified funds, but it's possible. So that's one example. But I also think on the opposite side of that, so harvest losses, obviously, but you should also strategically be harvesting gains. So tax loss harvesting only kicks the tax liability can down the road. You're not avoiding taxes. You're simply postponing them. And, I think that you can harvest losses strategically. So what you need to do at the end of the year, close to the end of the year, is you need to figure out, what is my income going to be? You need to come up with a rough income estimate. A lot of folks are in the habit of just letting their 1099s flow in, and they find out what their income is
at tax time.
Yeah, at tax time in January, February.
You can't do anything about it.
Correct. Don't do that. You need to get out your pay stubs. You need to get out your preliminary 1099s. If you don't know what that is, and talk with an advisor or your broker, or just figure that out. Figure out what your income is going to be, and you need to do an analysis and figure out, okay, where am I at in my bracket? If for example, if you're in the 12% bracket, which is a beautiful bracket to be in, now your income's not that high, but there's a lot of reasons you could be in the 12% bracket. The next step up above is 10% higher. It's to 22%. Like if you were leaving any money left in that 12% bracket, you are doing yourself a massive disservice. You should be harvesting any income that you can up to that 22% bracket. You want to cruise right under that radar level.
And by the way, typically long-term capital gains are actually taxed at 0%.
Bingo. That's another thing. So
which people don't realize this.
Yes. So you should absolutely be doing strategic. Don't just think about harvesting losses. Think about harvesting income. So you could do that with like Roth conversions. You could do that with realizing gains. By the way, there's no wash sale rule on realizing gains. So you can realize a gain and then rebuy the security right back.
You can do it in the same trade.
Same trade. Yep. So
the IRS is more than happy to let you pay your taxes. They're a little concerned with you avoiding taxes.
And there will never not be taxes on gains. Actually, I shouldn't say never.
Well, even that 0% federal bracket for long-term capital gains, it's not always 0% on the state level, right? So, but when you have the opportunity to recognize or realize, $10, $20, $30,000 of long-term capital gains for zero tax and reset your cost basis higher, gosh, that's a nice thing to be able to do to save some real dollars.
Yeah. So just strategic year-end tax planning is something I recommend. I also recommend especially if you're over 73 or 72, depending on what year you're born, you need to be make sure you need to confirm that you've taken out your required minimum distribution, because once January 2nd rolls around, it's too late. Now the IRS has changed the rules where they're more lenient. So if you quickly correct a delayed distribution, the penalty, well, you're not fined. The penalty gets reduced from 25% to 10%, but there's still a penalty. So make sure your required minimum distributions are out by December 31st. In fact, you should probably do it earlier.
Do you have a philosophy or a planning point around whether or not you should take the required distribution at the beginning of the year or the end of the year?
Yeah, I've never really thought about it. I just I do it at the client's pace because, clients typically need money at different points during the year. So I never really think about it in terms of like, when's the most opportune time to take it. I just let the client decide. I don't think in the grand scale, it really makes a big difference. I guess what you probably should do if you're trying to be optimal is wait to the end of the year and take it, because then you get to maximize the deferral.
Get more of the growth in the account.
And honestly, most people, that's what they do. They'll wait to the year end. That's the default setting, is wait to the year end. So we do a big project we start it in November, and we ultimately make sure that all of our clients have their RMD satisfied by December. And we do it by December 15th. We don't want to wait to the holidays because it can be tough to get a hold of people. Plus, we're out of the office the last week of the year. So we make sure that everybody's satisfied by that time. So that's kind of how we do it in terms of how anybody else does it. I know people that like to get it done right in January so they know it's done and they don't have to worry about it all year. I think that's a good way to do it too. It just depends on, how you feel about it. And if you're the kind of person that likes to get things done, check the box and move on, I would do it sooner rather than later. But RMDs are one of those things I would also recommend. We also talked briefly before the show about, 401k contributions. So if you're wanting to max out your 401k contribution, keep in mind, you can only contribute to, and this, by the way, I'm using 401k generically. I mean
this
like
your 403b,
any employer
TSP.
Retirement plan. Yeah. 457 deferred comp plans, things like that, 403bs. So you can only contribute to these things through payroll deduction most of the time,
unless there's not a whole lot of payroll left.
Correct. So if you have a target contribution in mind, the maximum for the year is $23,000 if you are 50 and younger, or 50 younger than 50. If you're 50 and older, you can do an extra $7,500. So you can do up to $30,500 in employee deferrals. So that's not employer. This is not including your employer match.
But the point is, it has to come from your paycheck,
and it has to be there by December 31st.
And the issue, if you're listening to this, this podcast isn't going to come out for a week, so we'll see.
It'll come out Monday, so we'll be there. This should be released on the 22nd.
But the issue is that if you want to make changes to increase your retirement contribution, you need to do that like now.
Yeah. Because
you may only get a couple of paychecks where that takes effect. So what we do for a lot of our clients is, mid-year, end of Q3, we're gathering paychecks and we're starting to project out income. So that, and there's a couple of reasons for this. Of course, as you mentioned, we want to recognize where they are in the tax brackets. Is there any benefit to either deferring or or accelerating income, whether it be capital gain or ordinary income. But we're also trying to check on, hey, how are your 401k contributions, your 403b contributions tracking? How are your HSA contributions tracking? What about the dependent care FSA? All of these different elements, just making sure that everything's funded properly. And then if we see something that doesn't line up, then at least we can raise that question to the client and make adjustments to it.
So the other thing was that we briefly discussed, and I'm going to repeat here, is if you do backdoor Roth contributions, now you have until April 15th or the tax filing deadline. Sometimes it's April 17th. I'm not sure what the difference is. Sometimes the weekend. Okay. That makes sense. But you have until the tax filing deadline to make the contribution. By the way, that's you can't, if you file an extension, you cannot make a contribution past the tax filing deadline. How confusing
is this? Because there are some things, like, for example, your personal IRA, you can contribute to that up until, or your 401k, you can only contribute that till 12/31, right? And then your IRA, you can do that until tax time. And then a SEP IRA, you can do that to tax time, including the extension. I mean, at some point, can they just say, okay, here's kind of the deadline for a lot of
that's what the Department of Government Efficiency is going to be for, Brent.
Well, I'm sure that, there's good reasons for a lot of it. I'm sure, we all work with business owners.
There are so many things in the IRS code that are backwards. Here's one that'll really rack your noodle. All right. So if you make too much money to contribute to a Roth, that's why we're talking about backdoor Roth contributions. So if you make over a certain amount, what is it, like 223,000, something like that, married filing jointly, I think it's
roughly 230
anyway,
something.
You can look up the ranges, but if you make too much money, you can't contribute directly to a Roth. So what you have to do is you have to contribute to an IRA, which you can do on a non-deductible basis, or it can be deductible. It depends on your income. Again, more confusion there, but I digress. And then you convert it immediately to a Roth. So anybody can do it. Warren Buffett, Elon Musk could do it. But if you make too much money moving forward in 2026, if you make over 143,000 or 145,000, your employer match has to be in a Roth. So in that example, you make too much money, so your contribution has to go to a Roth. You see what I'm saying? Yeah. It's like, oh my gosh, make up your mind. Do we make too much money for Roth or not enough money for the Roth?
Roth is such an interesting thing because it's actually like a great deal for all parties involved, because the U.S. population seems to love the idea of, like, let me pay my taxes now and grow this tax free. I think because it gives them certainty. But
Correct.
The government, from the government's perspective, they love it too, because they get their tax dollars today. I mean, people worry about the government reducing and kind of eliminating Roth over time. I think that's kind of ridiculous, because realistically, the government wants to take your dollars that are sitting in your IRA that you haven't paid any tax on and get the taxes on them. And they know that the reality is you aren't going to spend all that money in your lifetime. So they are trying to find ways to encourage you to either convert it to Roth to pay those taxes, or what they've done with these Secure Act rules is they've become less friendly with the rules around how anybody inherits these accounts from you, to force that money out and force that money to get taxed at higher rates. So anyway, but back to what to do for year end. So project out your income, look at the ability to strategically recognize capital gains, capital losses, evaluate whether or not your 401k, your IRAs are on the right track. HSA would fall in that bucket. Look at things like charitable, without going down a 10-minute rabbit hole on charitable here. Charitable contributions are probably one of the lowest hanging fruit for advisors to help clients be more effective. Well,
it kind of flows into the whole year-end tax planning and tax forecast. If you're doing charitable, well, I think it's good to be charitable regardless of tax reasons. But if you're trying to maximize the tax benefit of being charitable, you need to have that calculation done before the end of the year,
because that's all 12/31 deadline. So, and I think we have a podcast episode on that. So if you want to hear more about the charitable stuff, please go listen to that.
Yeah, check it out.
what other kinds of conversations are you having in your client end of year reviews?
Well, I wasn't completely done with the whole Roth conversion thing. I just wanted to say that there's the backdoor Roth is a 2-step process. So you have until April to convert or to make the contribution for 2023. But the conversion process, so converting from the traditional IRA to the Roth IRA, the 1099 that generates off of that conversion, it's based on the year the conversion is done. So if you're trying to be very neat and tidy and you want your backdoor Roth contribution to be all in 1 year, you need to do both the contribution and the conversion in the same year. So otherwise, what's going to happen is your Roth contribution will happen for 2024, and then you'll have to reconcile the 1099-R for that in 2025. So
totally. And the bottom line to that really should be that if you are doing a backdoor Roth IRA, please make sure that you have somebody, whether it's an advisor coordinating with a CPA or just a CPA that's familiar. As an advisor that reviews tax returns, it's one of the most common things to find issues is in backdoor Roth IRAs done incorrectly. So you can remember all of what Ben just said, but you should be, if you are at the wealth level and the income level where you are looking at backdoor Roth IRA contributions, as much as a lot of these folks, don't hire advisors because they don't, there are just some pitfalls that you really have to try to, know what to look for, and you want to make sure that you avoid, because oftentimes a lot of the clients that we work with, when they first come to us, they might be doing a backdoor Roth IRA, but it's getting listed in their tax return as taxable. And you think about $14,000 taxed at 30%, these are $4,000 or $5,000 mistakes in tax returns, and they're very easy to correct. So,
well, that pretty much sums up, I think, some of the hot buttons for year end.
Well, I have a couple of more. So
go for it.
I think other things that we could talk about, again, just to give the listeners a bit of a list, 529 contributions. Look at your state's rules. Every state administers their own 529. They also have different tax rules as far as how you get money back in your taxes for establishing that or not. That's something to look at. Make sure all of your FSAs, anything that you've been using for your company, that you've been deferring income, that's a use it or lose it. Make sure you've got that covered. A lot of conversations we're having around with clients around their employer stock purchase plans. Typically, those windows are December to make elections for the new year, and stock options. One thing we haven't talked about. We've talked a lot about employer retirement benefits, but a lot of our younger clients, they receive a lot of compensation through company stock, whether that be options or restricted stock units. So again, all of this starts with projecting your income. The first step is to project your income and say, okay, where do I sit in what brackets? Are there strategic moves to make? And then from there, okay, if we should accelerate income or we should defer income, what options do we have to do that?
So I think what we're kind of zeroing in on here is most of the year-end stuff is tax related.
Of course.
It's because it's obvious because that's the tax year starts in January 1st and ends December 31st.
And you should, there are studies out there that work to quantify the value of your financial advisor. And so many people feel like a financial advisor is there to invest your money. And absolutely part of our job is investing money. But if your financial planner isn't thinking about taxes, those studies would actually show that essentially about 40 to 50% of the bottom line dollars that get added to your wealth by your financial advisor is driven by tax savings.
Yeah, that's a lot about, that's about 50% of what is involved in like the whole estate planning thing, which I did want to touch on briefly, because one of the major things that one of the major messages we were trying to send out to the public was like estate planning awareness going into 2025 as it pertains to the TCJA, because the lifetime exemption, 13.61 million, is at a all-time high, meaning that you would have to have a net worth above 13.61 million in order to have to manage estate taxes, essentially. And it used to be that and it still could possibly be the case, but I doubt it, where the Tax Cuts and Jobs Act of 2017 was going to sunset in 2026, and that was going to get reverted back to the pre-2017 inflation adjusted levels. I think it was somewhere around like 7 million. So it was going to get reduced by like 6 million. Yeah, it was going to get cut by quite a lot, which would open up the estate tax problem to a lot more Americans. And it was going to cause a flood of demand for estate planning attorneys. And we've been saying to clients, like, get it done now, because if you wait till, middle of next year, it's going to be too late. You're not going to have an estate planner that's able to work with you on this. I think that with the election outcome the way it was, it's very likely one of the first things that gets done is the TCJA will get extended and probably expanded upon.
But that's going to happen amidst budget conversations.
Yep.
Amidst a debt ceiling. I mean, though the Republicans have a lot of control, there are a lot of these Republicans were brought into office on, fiscal responsibility.
Yes, that's correct. Yeah.
So, I'm really interested to see do they just blanket extend these tax cuts, or do they kind of surgically pick this apart? I mean, what is this really going to look like? And I don't think we have all of the information yet.
I think it's something to keep an eye on, but I'm going to make an educated guess here. And I think that the TCJA is probably not only going to be extended, I think it's going to be expanded upon. I think there's certain campaign promises that will meander its way through there. Like one of those is, I don't think Social Security taxes are going to be eliminated, but I do think that the Social Security income thresholds, which have not been inflation adjusted, Brent, since 1984, that $44,000 joint married filing jointly threshold, where if you make over $44,000 and what was it? It's like it's not adjusted gross income. It's some like Social Security
you got to add in some other stuff, sure.
But I think that's finally going to get inflation adjusted. So I think they're gonna keep that tax in place, but they're going to COLA adjust those thresholds. I think that is a possibility, and I also think that the whole no taxes on tips thing potentially may happen. Although I've heard some interesting rebuttal against that proposal. Like, okay, well, if there's no taxes on tips, what's to stop employers from abusing that? Where now they have, like, you see this all the time in restaurants where it's kind of like mandatory that you tip. They turn the tablet around to you after you swipe your card and say, it's going to ask you a question. And it's like, there's three options. You got 20%, 25% or 30%. And then there's this little tiny button that says cheapskate on the back corner. It says skip or something, so you could potentially see some abuse on that. And you might see some employers leverage tipping systems that aren't designed for that. Like I have to tip, my Grater's ice cream scooper now. 5 years ago, I didn't have to do that, but now I'm obligated to tip them. And by the way, I do because I feel guilty if I don't. So, but you can see how it could be abused. So it's going to be something to watch. Like, okay, well, do we actually see lower taxation or no taxation on tips? I think we will, but it will be relegated to traditional tipping roles. Like you have to be a waiter or a waitress, or you have to be, involved in some sort of business where you derive the majority of your income from tips. So, but yeah,
sounds complicated.
Yeah,
I don't know. I am on pins and needles, waiting to see what happens. I think I would like to say. I mean, well, I don't know if I would like to say. I think it seems easy to say the Republicans are just going to extend it. Mm-hmm. It's going to cost trillions of dollars on the budget to extend it, and so I don't know if it'll be that easy, but rest assured, it's something that we're going to be watching next year. And as we talk with clients, put out podcast episodes, we will be reflecting on okay, what are some of these changes and what do you need to be mindful of heading into the future so that you can be, in the driver's seat to some extent, because these government policies you have no control over, but you do have control over, how you manage around them. And for any listener that wants to get a little bit of additional information, in the show notes, we've included links to both Ben and my newsletters, as well as for this episode, we put a checklist on things to consider or considerations to be making before year end. So feel free to take a look at that. And if you have any questions, please consult with a CPA or qualified advisor. Thank you.
Yeah. So stay tuned. We're going to stay current with all this stuff as it changes, and we'll be here to give you our take on it.
To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Any company names noted herein are for educational purposes only and not an indication of trading intent or a solicitation of their products or services. Advisors associated with National Wealth Management Group may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of National Wealth Management Group. Or 2. Solely investment advisor representatives of National Wealth Management Group and not affiliated with LPL Financial. Investment advice offered through National Wealth Management Group, a registered investment advisor and separate entity from LPL Financial.